here to talk about PayFi and also how it relates to the subject of this conference. I'm the VP of Technology at Solana Foundation. So we're kind of the facilitating entity of the Solana blockchain. Where should I point this to? Yeah, green. Oh, there we go. All right. So the initial vision of blockchain cryptocurrency was Bitcoin, and the paper kind of draws out the peer-to-peer finance, peer-to-peer electronic cash. But obviously, as we know today, Bitcoin is more evolved into a store of capital, and it doesn't necessarily match the original vision. It's just not performant enough to actually facilitate that kind of commerce. And it hasn't necessarily even been extended to an entity-to-entity electronic cash system, which kind of relates to everybody here today. So it's kind of at the base of all this stuff is self-custody. So I can just use math to print some keys, and then no one else can know those keys until I don't know, 10 years from now, until quantum breaks them, and then we expand cryptography or whatever. Different conversation, but you can just spin up your own keys, and nobody, and it's just math, and nobody can generate those same keys. And so that's what self-custody means. I'm the only one who has access to that information, and there's cryptographic signing involved. That makes it so I can prove that I have ownership of that information. And then I can prove it to everybody else. And the blockchain kind of certifies that with everybody else. And therefore, you can do a whole litany of things. Bitcoin established the ability to do cryptocurrency, so everybody could agree who owned what in the amount of Bitcoin. But if you extend that beyond just a ledger of nominal amounts, you can actually do more logic on chain. Then you can start representing more complex things like property, or in this case, actual addresses and whatever digital property. I would actually maybe take a step back here. I actually think before you have this ability for everybody to agree on who owns what and people to permissionlessly own stuff with verifiable in a verifiable way. Cryptography is just a way to do that verifiable way, but until that moment, I would argue that nobody owned a digital thing. Everything digital was brokered or behind a terminal of service or on somebody else's asset. Even the things that you kind of own, like your photos on your phone, you own your phone, not necessarily the digital thing. I would say the closest thing to a digital thing that you theoretically own is something like an IP. So you could have somebody who has ownership over an IP that is represented digitally, but not actually the digital thing itself. And so blockchain gives you the technology pieces necessary for you to own digital things. All right, so and that basically so you can do programmatic money. So MetaMask, kind of shown here, and that's kind of the Ethereum was the first one to really certify these things and make them usable to the common person. I could load a browser extension, and then boom, I have access to digital things, and I can spend them and use them how I wish on the internet. That's basically what ownership means, right? I can do things on my own accord that I don't need to ask for permission from other people, which is the kind of the broker model. There is no terms of service. So, and then you have books like this that kind of really paved the way to the future forward thinking of these amazing terms. It's a really good book, The Sovereign Individual. You should all read it. It kind of just describes the theory of blockchain, why they exist, why the brokered systems are pretty limited, and cause a bunch of frictions. You may have seen this kind of nomenclature, Web 2 to Web 3. Like anything like this, it just becomes widely used and then loses all meaning. So I'm going to try to describe it more from base principles, as you can kind of tell from this talk. So you have the internet, and that's where a lot of domains and DNS routing and all that, I don't have to explain that to you. What all that digital property rights gives you is the ability to actually transact in a way that I am the one who goes from .com to .xyz, or even owns the .xyz itself, and that access rights are controlled in a permissionless way. Now, I'll go into some more details later, but like this is basically adding a financial and data layer onto the art. Like, you know, the internet itself is a very decentralized, like a pretty decentralized model. You have a bunch of people who can kind of certify, you know, route, and as long as it gets to one address to the other and it gets routed correctly, anybody can spin up a server kind of anywhere and, you know, have access to this, like, this open web. So what blockchains do is provide the ability to own the data that gets passed over that web. Yeah, and then that can facilitate commerce, as I'm talking about. So taking a step back, kind of like what is Bitcoin? It was always like it's now a store of value, but it's kind of moved away from the kind of the medium of exchange. And so this is where I kind of shill Solana a little bit. You kind of need something that is faster and cheaper 24/7. Like I would argue even Bitcoin is way faster than traditional finance at a lot of things. Like just think of settlement of any cross-border payment is T+5 or something. It's a really, really long time to actually get full settlement, and Bitcoin can do it in hours and not days. But if you're really going to disrupt that classical model, you really need to like absolutely 10x. So like hours and, you know, a few dollars per transaction probably isn't quite good enough to totally disrupt the classical financial model. You need something that is 10x better and way less friction. Yeah, and these new technologies can enable new markets, which I will talk about a little bit, and, you know, put up some like archaic things here that show like, you know, a lot of things that used to be kind of the standard can really get disrupted pretty quickly once you show this 10x potential. Yeah, so you can enable use cases. So introducing PayFi. So DeFi, which you've probably heard of, is decentralized finance. It's taking everything that happens on NASDAQ or whatever market or commodity trading and putting it into the hands of, you know, the digital assets rights that I said. You can own digital things and you can control what markets they're traded on 24/7. Like, you know, you control that. So that's decentralized trading that happens today in DeFi. PayFi is adding those aspects of digital ownership and collaboration and permissionlessly figuring out how you want to use your assets and applying that to commerce. And some magic can start happening. So it allows for new financial primitives. It goes to settlement, not just trades. So you can actually do peer-to-peer trading or like business transaction and not just speculative, you know, I'm swapping into this because number goes up. It's like actually using these digital rights to do something. Yeah, and it also creates the time value of money. These highly liquid, if you can have these 24/7 low friction markets that are 10x better than the long settlement time, the time value of money really goes up. You don't have money just sitting waiting for it to be faxed, and that creates a lot of efficiencies in these types of markets. And then also digital rights like domains. And those can even be traded, and yeah, I can get into some of the cool things that can happen with that. So there's three conditions that you kind of have to happen in order for these, again, to be 10x better and actually open up to new business opportunities. So they have to be performant enough. You actually have to get the settlement time and the actual usability increase. You have to have the talent liquidity. You have to actually have the people build the things. Like in order for the property rights to be valuable, your ownership to be valuable, you have to be able to do things permissionlessly. And so that's where talent comes in, so to make things that you can have the freedom of choice. Otherwise, you know, there's theoretical things you can do with it, but you don't actually have the ability to do stuff. So that's why it really matters that, like, you know, projects like these, putting top-level domains and tokenizing them, because that's one more thing I can interact with anything that is, you know, tokenized somewhere else. And then capital liquidity. So the liquidity of domains and liquidity of, you know, access rights and all that other stuff makes it so you can combine them with other types of tokens. And yeah, so those are the three things that you kind of need, and then you can unlock a whole litany of other things. And you know, here kind of just show Solana too. So Solana is a really great place to do that. So this is from Circle. Circle kind of posts how much time they will take to give you anywhere from 1 cent to $100 billion or whatever is in their treasury. So they will certify it in 400 milliseconds because Solana has never had a rollback in the history of the chain, and it's a very stable chain. They notably had some performance issues, probably a couple years ago, but it is a very, very stable chain today and has never had a rollback. And so you're so confident once your transaction gets confirmed that, that Circle is willing to give you a ridiculous amount of money, and that's the settlement time, 400 milliseconds. And obviously that's way more than 10x the even Bitcoin, but certainly the traditional financial markets. Also, there's a ton of liquidity. This is actually pretty outdated. Not only has the volume gone up, the TVL of stablecoins on Solana is north of 11 billion now. So there's just a lot of capital on chain. This is by stablecoins, I mean things that are backed by either US dollars or some other sort of collateralized asset. And so there's just tons of liquidity on chain, if you can't tell by the Trump launch. Okay, so there's also talent liquidity. This is even outdated. I think there's something like, Solana is like one of the fastest growing and highest developer ecosystems in all of crypto. Actually, fastest growing in basically the tech space, but certainly in crypto. Okay, so kind of like said another way what I was saying earlier. So it's kind of like fast and cheap, developers developing things that you can actually use on it, and money people can actually use. So I'm going to go through like a few things here that like traditional finance kind of have. So you have this ability to both save, invest, and pay all in one place. And you can actually have assets involved. So this is like this buy now, pay never idea, where you can actually have an asset. You can have it on a lending platform, and you can get yield from that. And that yield is what actually allows you to pay for things. So from the user's perspective, instead of a savings account that's just kind of sitting there and they don't really know what to do with it, and it's like very low yield or whatever, you can really start making that liquid in this very user-centric way where they can really start paying for things. And relevant to this conversation, maybe if you already have tokenized your website, maybe you can just have the payment for that website just come from some yield that you put on. So I'm running a business, I have some treasury that I don't want to have in some risk-based asset. I just use my US, the stablecoin, one of the 11 billion on Solana. I get some yield from it, and that just pays for my website over time in a very low-risk way. And so I don't have to, the other really interesting thing about this kind of model is the bookkeeping is way simpler. I don't have to do the accounting, then that I get some funds from somebody else, and then I do the PAX payroll, all that stuff, and then I pay out to some other invoice. I just one time set whatever this website has for in terms of me staking to it, I stake to it, and then they just invoice however much income that is. I don't have to worry about it after that. This is where I'm talking about like the 10x better, low friction, highly liquid markets, is that once that agreement is set on how much I have to stake to that entity, say it's $100 for the year, like a low one up to $10,000, like that's just really, really efficient. I just work that into my P&L and I'm on my way. Also, you can do that the other way, where maybe your people do that for you instead of. Maybe you have a subscriber base, and that subscription looks like them just staking to you in some yield-based way, and then they can pay for things over time, and you get the yield from that, and then you can pay for things like phones or whatever your commerce site is. And it's both low liquid, or highly liquid, in a way that is really user-friendly to the user, because they don't really feel like they're spending that much money. It just feels like they're just putting up something that they believe in, they're staking to some entity, and then you get just trickled in payments over time. And again, the bookkeeping is really simple. They just have some spending limit, and they can buy things over time. Here we have listed a phone. So this is kind of like a depiction that ChatGPT thought of this, where you basically have your website, you have your servers that you have to pay for, and all of it's backed by this like digital economy. You don't have to worry about interfacing with Stripe and all these things. And even I've talked to D3 about this. There's even ways that you can potentially just pay through the domain itself. I don't even have to set up a payments page. People can just pay into, like if it's matt.com, I can just have my users pay matt.com with a memo, and I know exactly what they're paying for, and it just gets, under the hood, we work to route that correctly, but you don't have to spend however many bips, 200 bips on Stripe or whatever else. You just have this underlying payments layer that's super efficient with instant settlement all around the world. Because the other thing about this is it's just an address that works just like the internet. I don't have to worry about whatever financial gated system there is. It's just it just gets the payouts. And because you're on this open collaborative system, somebody in that jurisdiction most likely has figured out with whatever token how to pay it out. In fact, that's even part of this. When you're on an open collaborative platform right next to the rest of DeFi, if somebody pays me in Trump token, I can just have it under the hood swapped to USDC for me. I don't even have to think about it. I don't have to think about what the exchange rate is. I don't want to think about it. It's all atomic. I say, I want to get paid in $5. I don't care how that $5 gets to me. You can pay with whatever token you want, and the underlying finance layer will take care of it for me. As long as 5 USDC enters my bank account, I don't care. Yeah, and so that goes for paying the servers, paying for everything. Google Cloud today accepts Solana-based payments, both stablecoins and Sol. So eventually these will extend out farther and farther into where you can have your entire commerce facilitated through just low friction environments. All right, so we just talked about a bunch of stuff today. Domain rights, value transfer and subscriptions. Oh yeah, the other thing is like auth and KYC. So like both the ownership of the domain itself, but if you have people running around the internet with these cryptographic keys, that is a representation of themselves. And they can even choose, like go from like cookies that run around the internet to, you can see a public address and the user can kind of have control through different kind of permission settings in encryption, which parts they expose to the sites as they browse around the internet. And then the sites can choose how to use that information. And it all happens to the user kind of seamlessly. Kind of the way cookies are today, but where the user's more in control. And there's more of a payment layer there. That's the main thing. Like when you're going around the internet today, cookies go with you, but not necessarily value transfer information. That's really seamless. So, but if a user's already going around, they can have all that stuff kind of built in. Yeah, so it's kind of just basically a new primitive for the open internet. And yeah, I could go into like a bunch of other stuff. That's generally what, yeah, we don't need to bore you with all the really financial stuff. But yeah, in conclusion, PayFi is like tokenizing time value of money, new profits, new payment methods, and from speculative to transactional on-chain economy. So yeah, like today, most of the on-chain economy is speculative, just because that's the easiest thing to tokenize right away. But but part of the reason why we're getting deeper and deeper in this is, like, as you have more connections and more layers on this, it gets more complex, and you add more and more interesting things that just facilitate commerce. Yeah. All right. I don't know if we have any time for questions or anything, or if I'm just done.
Few questions.
How does compliance, or do you incorporate compliance into your workflow?
Compliance?
In terms of like regulatory, KYC type things, and stuff like that.
Yeah. So compliance is kind of, so the interesting thing, the blockchain is just going to be a permissionless platform that allows you to essentially do anything. So the compliance is going to be relative to whatever your system you're in. And the blockchain is there to be flexible enough to comply with that. So I can give you a couple examples. One that's kind of out today. So there's a type of token on Solana called token extensions that allows you to do compliant things, either having conditional transfers, so you can have a block list to some OFAC sanctioned addresses, or allow lists to token holders, and that token could be a KYC. So that's the other part of it. So these are where the technologies kind of combine. So you have one thing that can gate based on arbitrary logic, and then you have the other side where you can have ID information, either from some private ZK or some other credentialing entity. I mean, the utopia would be a government doing some sort of citizenship, but it could be anything. It could be some insurance broker saying this person has renter's insurance or something like that, and then that can allow you to rent an apartment, for example. So yeah. So it really just depends on what kind of regulatory standing is in that location, and then these kind of technologies can combine. We're actually putting a big push for identity layers as well, and then on that identity is anybody can kind of attach some sort of credential on top of that identity layer, like citizenship information, but also credit scores, whatever other active subscriptions, whatever else.
You mentioned like talent density, capital density. If the domains were sitting on Solana, what does it mean from like an end user standpoint? What does that unlock with the network effects of Solana?
By end user, you mean the website owner?
Oh yeah, the domain owners.
Yeah, yeah. So the domain owner can really, I think the lowest hanging fruit is just being able to have that domain also be under the hood, have a record for an on-chain address, so you can do payments directly through that address. So you can actually just say, pay this through and describe a flow, and they can have an embedded wallet right in their site. And so if a user already has a Solana ID, that's great. And a lot of them are just tied to their Google or social login. So as long as they have something there, or they can, or a lot of them, their embedded website could have an easy on-ramp provider for people who don't. But the goal is like, just like the emails got proliferated, that people would get used to more and more having an email, like this version, this new type of email, their, .sol or that kind of thing. And then they would, unlock payments right away. But then, honestly, like the sky's the limit. It could be any type of finance. I could even do something where like I take out a collateralized loan based on my decently valuable mat.sol. I don't know. It's a pretty cool name. So you take out some sort of collateralized loan on that, or again, you can do all your financing and payments for the servers and all that architecture itself. And the other thing that you can kind of start thinking about too is if people are coming to me and just like paying me through that, I don't just get a credit card number. I actually get a view of that person. Or at least some record that they choose to show, because again, they can choose which addresses to choose for which kind of type of purchases. But you can see kind of like roughly what other things they're interacting with, what NFTs they hold, what other commerce they have done, and I can personalize and maybe do some sort of, that can help with my re-engagement. And what it kind of offers. So if I see that they already have 5 subscriptions other places, maybe I could do a similar type of offering to them. And I don't know, maybe even like do AI so it all happens automatically. You maybe not even had that model, but you see that it's popular with them, and you're like, oh, they like monetizing by paying $5 a month. I'm going to figure out how to just charge them $5 a month. So when everything's just connected just through with these like really, really flexible payment methods, like magic can happen there. You can just start charging people however they want to be charged, as long as it's profitable for you.
So, the pay never is coming from yield, right?
Yeah.
So, but yield seems to be the Achilles heel on a lot of these things. Where's the yield coming from? Currently, a lot of it's coming from T-bills, I guess.
So the underlying, so either the asset is sharing some of the T-bills that is locked, so it's just making T-bills a little bit more liquid, essentially, or it's just coming from people borrowing.
So they are, but I'm just saying, it is a big part of a lot of these projects is the yield. So there is like some substantial risk there as yields go down.
Yeah,
or you have
you'd have to.
loans.
So this isn't a riskless thing. You would have to have some. It would be part of the contract. There's always risks that somebody just doesn't pay the next month. So you just have to work that into whatever financial modeling you do with whatever the contract is.
But the yield is coming from you. Maybe we can talk after. I'm just curious on where you're talking about staking. To be able to pay for things later on effectively, right? So you're putting $50,000 in X, getting that yield, being able to use that for other things.
Yeah.
Right. Okay.
Yeah. So, from yield. So the way these roughly works is there's a lot of kind of yield kinds of yield. So I'll just maybe briefly describe them. What he was talking about is a lot of the stablecoin issuers store U.S. dollars in a bank, and they're getting some mixture of low risk, hopefully, T-bills, other financial things. It's actually, it's not a bank, but it kind of operates similar, where they have some percent liquid that they can pay out right away, and then they have some over some short period of time. And some of them pass that earnings off to the user. So you can get some yield from that, but there's also yield just from allowing to borrow. So one of the slides had a little K on it. So Camino is a thing on Solana where other people will just take out loans. They don't want to, say they don't want to spend their Bitcoin. They can take out a loan against their Bitcoin because they don't want to, incur cap gain, taxes or whatever on it. But they want to still hold it, but they want to be a little bit more liquid. They'll use Bitcoin as collateral and take out a loan. And so you, as the person who is giving $50,000 of USDC, just get a yield based on that loan that somebody else has taken out. So it's it's not like some spoofed yield or something like that. Like it's just finance. Instead of a bank doing it though, it's a collateralized loan that somebody's paying some bips per, bips per month on. So that's where that yield comes from.
Questions? I think we have time for a few more.
Hey, Matt, thanks. I wanted to pull the string on the buy now, pay never.
Yeah.
So essentially, from a domain perspective, being on chain allows the domain to get yield on it, unlock value, and that's where the owner of the domain starts yield coming in, and that pays for the servers and the services and everything, right? Just wanted to clarify that.
Yeah, exactly. The idea is just what I'm not making a determination of what in your stack has value, but yeah, if you just have, say, okay, I'm a 2-time founder, and I know that somebody gives me money to start a business. Say it's $100,000. Like I want to have that in a low risk place. Like my business is the risky one. I shouldn't have some sort of underlying risk to that. So usually you put it in some just like very, very low risk, something. But what if you can actually use that in again, there's some risk involved in DeFi, but just some very low risk part of it. Again, just something that's just generating yield based on typical like T-bill type yield. And I don't have to think about it now. I can just put that there, and that'll just satisfy that part of my P&L. And I don't have to keep on doing that bookkeeping. I just sign some sort of contract and it goes. The other thing is like, tax benefits too. I don't have to accept something from some customer, pay tax on that, and then figure out some bookkeeping and route it back out to pay my bill. I just come up with, hopefully, a very simple one-time. Obviously the contracts can be different on what the payment is to the hardware provider. But yeah, hopefully I could just stick it in there and then generate yield and seamlessly pay. And have some pool of capital there for that. Or, even if it's not necessarily that I'm doing that relationship directly with the thing, this could work just like completely on my side. Instead of me setting up a relationship Google where I'm staking to them, and I could just set up a pool where my internal software just pays out of that staked pool yield. Like it doesn't have to be some new type of thing where all parties agree on this or whatever. It's code, right? It's very flexible. Like I know that this will yield approximately 5% per year. That gives me around a budget like this before it starts dipping into the principal or dipping into the my base of funds, and that's my my budget for whatever services. So, and then you can just code that. And the point of it being not in a bank account is that you're in this like completely programmatic platform that you can start doing like really cool things. You can even have it so like as money comes in, the parameters adjust, and then all of a sudden you can spend more. It's like an automatic load balancer based on how profitable whatever your app is. And then eventually, this stuff is going to become basically completely permissionless. So like, another thing that blockchains are really good at is price discovery. So like any AI application right now has a really, really hard time pricing itself correctly. Up to OpenAI doesn't price itself correctly by its own admission. So you can start doing something where maybe you can actually price things on an open market on crypto, and then have the underlying cost structure just work it out just based on whatever that pricing, like whatever willingness to pay are, I can adjust my cost just programmatically on chain, and your customers can transparently see why they're getting charged and what the profit, whatever. So you can start doing this stuff in a very programmatic way and not have it have like as intense finance or even like BD departments doing all this pricing and everything. Like it can just kind of happen automatically, and that you can pass that savings on to your profitability. Yeah, dynamic pricing or whatever. This is basically, okay, say what you will about like meme coins and NFTs or whatever, but they're priced based on like a market rate really, really like accurately relative to, people's intentions. I don't know what accurately means in terms of like the actual value of the things, but just move that same primitives, NFTs representing domains now and tokens representing whatever other currency, then now you just have this pricing engine for, commerce.
We have one more here.
Hey, thank you. I'm personally really excited about payments as a space in crypto. I'm curious at Solana Pay, how are you thinking about, what are the first couple waves of prioritizing onboarding? Like, are you thinking about prioritizing merchants? Are you thinking about onboarding consumers? Is it like Solana wallet holders, something else?
This is the huge question. Like, what comes first? Because like once once you, just like email, once people start using it and people certifying it, eventually you start using it for DocuSign and like really crazy documents, right? But that's like, took a really long time for us to, people forget, like at first everybody was like scared of email and there's so many scams and people are sending to princes in Nairobi or whatever. And so, and it was really scary for a lot of people. And then and again, now people are totally happy to just with location and check and email sign for billion-dollar contracts with just an email. And so we'll eventually get there. But yeah, today, I think individual merchants is kind of hard. If somebody, we want to make it as easy for a merchant to self-select or a point of sale thing to create something that is easy. Those would probably find the best product market fit in something international where people are having to deal with exchange rates and other stuff like that. But we found it honestly, a lot of digital things. We've held a lot of digital sales for the Solana phone, for our own conferences. A lot of stuff, that stuff is actually super good. We have people coming from around the world to come to these things, and we don't have to worry about any of the other layers and exchange rates, and that just is handled on whatever integration that other people have chosen. So I think digital things, digital events is probably the lowest hanging fruit. I don't see why anybody wouldn't just start using crypto for that. And people are. I mean, people are using it right now for casinos all the time, and not meme coin casinos, but just stake.com has a bunch of crypto integrations, these things. But it's the lowest hanging fruit is kind of these people who just are doing rapid payments. I think as you get more and more deeper integrations, it'll just become lower hanging fruit for more and more types of commerce. Yeah, but I would start digital. That's why actually something like this is the perfect example. It's a digital thing. It's a digital property right. I think this is the perfect application for start doing payments for domains and having markets for domains all on chain, so internationally people can kind of bid on them and transact. So this is actually a good example, but I think there's a whole class of things. And that's why people have kind of gone after video games. There's a whole other problems with fun and over monetization of games, but they're also completely digital. So if you kind of open those economies, maybe, but there's a whole slew of other problems there, but yeah.
Awesome. Thank you, Matt. I think that concludes our Web3 session, and we are moving on to our final session.